has a very serviceable bistro that we use from time to time. Um, so welcome, David. David is the client director in the corporate finance practice at Pitcher Partners, and he leads Pitcher Partners' financial modelling team, working day to day with clients to provide them with insights into key business projects and also financial clarity for decision making. He's very experienced in both building and reviewing financial models across a range of industries and for different purposes, including M&A, tender modelling, strategic planning, business cases, debt and capital raising. He has significant experience in supporting clients for contract negotiations and tenders, and works with clients to assist them in modelling costs, responding to bids and supporting negotiations. Also has experience across a range of industries from transport and manufacturing to not-for-profit and hospitality and many more. So before I introduce David, I'd just indicate that we're recording this seminar. Please let us know if that's an issue, and we can discuss cutting you out. Also, if people can just keep their microphones off during the seminar, that would be great. If you have any questions during the session, please just put them in the chat. But there will be a Q&A session at the end that I'll facilitate. And in that case, just give your name, designation, and company, and either fire off the question verbally or in the chat. But look, without any further ado, I will introduce David Fennell to give a PowerPoint presentation on budgeting and forecasting for better business decisions. Thank you.
Thanks, Chris, and good morning, everyone. It's great to be able to talk to you about budget and forecasting today. My goal is really to provide some useful, relevant and practical information to as many of you as possible. And with that in mind, I'm going to be focusing on the three major reasons why I see clients preparing budgets, forecasts, or financial models. I'll use that language interchangeably as we go through the presentation. I might just get the next. Have I got control of the slides? Yeah, great, thank you. So yeah, I want to talk through these three major reasons why business need to prepare forecasts. And I'll start with budgeting and forecasting, day-to-day financial management, what good looks like from that perspective, and how you can expand on what you might be doing today. I'll then talk about forecasting for sourcing debt. So if you're out talking to banks looking to borrow some new or additional debt and are required to put together a financial model, what a good information pack looks like and what are some of the things that you should be thinking about. And then I'll finish by talking about modelling for decision making, which is really where the business has some kind of project, some opportunity for expansion that requires investment, and requires some analysis to help facilitate decisions in relation to that project. So I'll start, though, with budgeting and forecasting, and I guess thinking about what entry level is. Maybe first, though, I'll say the clients I work with do a number of things when it comes to budgeting and forecasting, from nothing at all. So I do have clients that don't prepare a budget at all, through to clients that prepare a detailed profit and loss budget, would spend weeks and months preparing that, would be updating it through the year, and have quite a sophisticated process. So I do see everything, but what I guess I see as that entry level, and if you're not doing much today, is a good first step, is to be preparing an annual profit and loss budget before the financial year starts. And we know that that is quite valuable from a financial management perspective for businesses. And we know that research tells us that businesses that do plan and do prepare budgets will typically outperform those that don't. And the reason why that is because it helps business to set targets for the year ahead, which gives them something to aim towards. And it also helps them to provide a base to measure against through the year. So having set a budget, it provides a comparison to actuals. It gives you the ability to analyze performance against the budget and investigate why performance is different to what was expected. Another important aspect of preparing an annual budget is cost control. And this can be important. It's important for all organisations, but can be particularly important for some organisations. I sit on the committee of management for my daughter's daycare, so only a smaller organisation, but we have an annual budget, and that's a really important part of our cost control process to making sure that we have a limited amount of revenue that comes in each year, and we may need to make sure that our costs are maintained within that revenue. And so that budget really is part of our cost control processes and helps us to stay on track through the year. And it's the same thing for a number of businesses where that profit and loss budget can be used for cost control. It also helps you to think about resource allocation and how resources can be utilised in different parts of the business through the year, and whether additional resources can be required. So that's, as I say, profit and loss budget is really the entry point for budgeting, and it can provide a lot of value. If you're already preparing a profit and loss budget within your business and you want to think about how you can expand on that and provide some additional financial information that is beneficial into the business, there's a few things I think you can think about. The first one is taking that profit and loss budget and expanding it out to what we call a three-way model. So in addition to the profit and loss budget, also forecasting out a balance sheet and a cash flow. There's two broad benefits to doing that. First of all, in forecasting out the balance sheet and the cash flow, you increase the overall quality and robustness of the forecast themselves. So the integration of those three financial statements, P&L, balance sheet, and cash flow, when prepared together, makes for a higher quality model. It increases the chances of identifying potential errors that can creep in. More specifically, it provides you with additional information that you don't get from the profit and loss budget. So the profit and loss gives us a good understanding of earnings throughout the year, but it doesn't give us a view of cash flows, because it doesn't give us a view of our capital expenditure that might be required through the year, our debt repayments, and any impacts from working capital movements. And that's what the balance sheet and cash flow forecast can give us, and give us more insight for the year ahead, and potentially alert us to any potential funding difficulties or funding shortfalls, which can be planned for if they are known about. Another aspect that you can consider is the frequency of your budgeting and forecasting. So if you're just preparing an annual budget, you could consider reforecasting, whether it's biannually, quarterly, or even monthly. There's no set rules as to what a business should do or what's recommended. It's very much specific to the business, and it'll depend upon the extent to which I suppose there's volatility or unpredictability in the business. If revenues and costs are relatively predictable, there may not be a need to be reforecasting monthly or even quarterly. But I'd encourage you to think about it, and you can think about it from a couple of different perspectives. First of all, as you get through the year, and let's say we get to the end of the September quarter and maybe we want to do a reforecast, we can update our budget for 3 months of actuals to give us an understanding of, with those 3 months of actuals and 9 months of budget, what our performance looks like, forecast for the end of the financial year. You can update that remaining 9 months forecast for any significant known changes in the business which you didn't know about when you set the budget. And you can also forecast out another 3 months. So you've got that rolling 12-month view of what's ahead of you. And then the final thing I wanted to talk to in terms of budgeting and forecasting, and I think this is something that can add a lot of value to the budgeting and forecasting process is sensitivity and scenario analysis. So I'll describe the difference between those two things and then talk about the benefit of undertaking sensitivity and scenario analysis. So sensitivity analysis is when, if you think about, you've prepared your budget. So let's say for FY26, you've agreed what your budget is, and then you look at what changes in individual variables to the budget or to the business and the impact that they have on earnings and cash flow. So an example of that could be changing sale price, increasing or decreasing sales volume, looking at changes in interest rates or exchange rates. And by focusing on changing an individual variable within the model, it gives us a really good understanding of how sensitive the earnings and the cash flows of the business are to changes in that variable, and really helps us understand risk in the business and what are the specific risks that we should be most alert to. Scenario analysis, on the other hand, is where we look at changes in several variables. So again, if you think about having set your base case budget, you might look at, an increase in sales price and an increase in interest rates and a change in exchange rates. Or alternately, you might be in a position where you know that you've got a potential for a new customer, a new large customer, or a new large contract to come on in the next 3 months. You weren't aware of that at the time of setting a budget, and you want to have a look at that scenario and consider what that looks like. The extent to which you can set up the budgets and the models that you use in your business to incorporate, whether it's sensitivity analysis, and even if you're just doing sensitivity analysis, I'd say that's really powerful, but also scenario analysis. What I'm showing on this page here, I guess, is just an example of, if you've done that work, if you've undertaken some sensitivity analysis, how you can summarize that back into the business at a high level to help explain those risks or what those scenarios will look like if they play out. So on the left-hand side, we're looking at, for the different variables we've considered in sensitivity analysis, a project finishing earlier or being delayed, increases or decreases in CapEx, increased wage costs, changes in foreign exchange rate and interest rates, which particular variables have the highest impact on profitability or earnings before tax. And we're showing similar things here on the right-hand side in these tables, but looking at a profit perspective, but also cash flows, cash balance, and the impact on debt. I'll keep moving in the interest of time, but I think we'll make these slides available if you wanted to spend more time looking at those examples. I'll move on to forecasting for debt sourcing now. And so, there'll be times when you are talking to banks and looking to borrow, whether it's additional funds or new funds, which might be for growth projects or to refinancing your existing facilities. And from time to time, you may need to provide forecasts to support those debt applications. So it won't always be required. And there's instances which are indicative of needing to prepare forecasts to support debt applications. So I'll quickly talk to what some of those are. If the facilities that you require are more reliant on the cash flows of the business to repay the facility, it's more likely that a set of forecasts might be required. That really goes hand in hand with security. So if there's less security or less assets available to secure the debt against, the debt is more reliant on the cash flows. And so, again, more likely that forecast might be required. And lastly, the extent to which leverage is higher or lower. So basically, how much debt are you asking for compared to the base of assets? And the more you push that, probably the more likely that forecasts will be required to provide to the bank and provide them with comfort on the amount that you're looking to borrow. So what I'm going to talk through in terms of preparing forecasts specifically for banks is what a good forecast look like for that perspective. And at the end of the day, good forecast information speaks to the quality of management and the quality of the business. So I'll talk through what quality forecasts look like in terms of providing them to banks. I'll talk to how the forecast should tell the story of the business, its growth, and the requirement for debt. And then I'll also talk about measuring covenants, which is particular financial measures that banks will use to assess your application, and you should also be trying to calculate and measure in order to inform your debt process. So start by looking at forecasts and what are the things to think about in the set of forecasts and the forecast information you provide to the bank. I've already spoken about three-way forecasts and the fact that a profit and loss, balance sheet, and cash flow budget that includes all three of those financial statements is considered to be superior. Banks are quite aware of that. Individual bankers might not have a strong understanding of what a three-way is and how to prepare it. Some will, but they'll all be aware that a three-way forecast is preferred and it is of a higher quality. And to some extent, if the business can produce that as part of a debt application, it does kind of bolster financial credibility. The other thing to think about is terms. So how far out are you going to forecast to provide to the banks to support your application? This will be different for different circumstances, but in the absence of any other information, I would say you need to finish forecasting out. So on a monthly basis, forecast out the remainder of the financial year. So we're in FY26 at the moment, forecasting out to the end of FY26, and then adding another 2 financial years. In some circumstances, you might be able to get away with just forecasting out 1 year. In others, you may need to go further. If you have, for example, a new large 5-year project or 5-year contract, the bank might want to see the forecast out for that term, or if you're taking on a significant facility and you need to demonstrate paying down that facility again, you might need to go out a little bit further. I think the other thing to think about is making sure that you've got a quality model. So typically the banks will actually want to see the Excel spreadsheet, and ideally that is well structured. It separates, the key areas of the spreadsheet being the inputs and the assumptions compared to the calculations, and of course the financial outputs themselves. It should look professional. It should be easy for the audience, being the bank, to understand. And I think that partly goes to making it easier and thinking about the audience and making sure that they can understand the information that's in the model for the specific purpose that's being prepared. So if we think about a circumstance where debt is required because of a expansion of a business for a new large contract, you should think about what goes into the forecast and how you display them to explain what's happening in relation to that project. So if it's a new large contract and you're forecasting out the profit and loss statement, you might separate existing revenue in the business to revenue related to this new project. Equally, in the balance sheet and the cash flow, you might segregate existing debt and the new debt facility that you're asking for and the drawdown of that facility in the cash flow. So just thinking about the information that you're going to show to the bank and making it easy to understand what you're putting forward in the forecasts. And I think that partly goes to making sure that the forecasts tell the story of the business. They support explaining the growth that's happening and the reason for the debt requirement. So it's important that typically, when you submit your debt application, and if there's forecasts that go with that, there will have been a lot of communication that's already occurred with the bank. And ideally, the forecast that you put forward should be consistent with that communication that's occurred. There'll always be changes along the way, but the extent to which the forecasts are supporting that story is important. And one of the things that I guess the forecasts need to demonstrate and support is what's the amount of the debt required. Now, in its simplest form, the forecast should show and explain what the debt requirement is and how much debt will be drawn down. But more fundamentally, the forecast over time need to support that debt is required. What I do see from time to time is, if say an example of a business that might need a $5 million debt facility, and they've got a set of forecasts which they're ready to send off to the bank. And we've drawn down $5 million. And what we see a month or 2 or 3 months afterwards is that we're building up significant cash balances of $2.5 million. And it kind of raises the question as to, do you really need that $5 million debt facility, or is it more like 3.5 or 4? So making sure that what you're asking for and what you're putting forward in your forecasts are consistent, and it doesn't undermine the requirement for debt or the ask for debt. The forecasts also need to explain how and show how the debt will be serviced from the cash flows over the term of the forecast. It's also worth thinking about when you put forward your forecasts, thinking about security and what the bank's going to be looking like. And I guess what I'm referring to here is that businesses are often structured across several entities, and it's typical to have asset owning entities and operations entities. And when we're preparing forecasts, we can be quite focused on the operational entities and the revenues and the costs and the employees. But banks will be interested to see often the assets which they might be securing against. So when it comes to preparing your forecasts, it's worth thinking about, am I forecasting out the operating entity by itself, or am I forecasting the group in order to give the bank the full picture and the information that they're going to be interested in? The last thing I just want to touch on from a debt perspective is debt covenants. As I said earlier, banks will measure these as part of their credit application processes, and it's really a good idea if you can do this as well. So there's a number of different debt covenants, and they can vary slightly from bank to bank and industry to industry in terms of how they're measured. But some of the key ones are interest cover ratio and debt cover ratio. Both of these ratios measure the ability of a business to service their interest payments, or in the case of debt cover ratio, their total debt payments, so interest plus repayments of the loan. And higher measurements or higher ratios indicate a higher ability to service debt. Another common metric is debt to EBITDA, which informs leverage and can be used to size debt sometimes by banks. So banks will typically measure all of these. And if you've gone to the effort of forecasting out for several years, you've got really most or all of the information you need to prepare these calculations. And in preparing them, that'll give you an understanding of what the bank's going to see before you send it to them. And it can highlight issues which you can adjust for before you make your submission. You obviously need to interpret that information, and that's where your accountant or your debt advisor can support you. All right, I'll move on from debt forecasting and talk about forecasting for decision making. And as I said, this is really where there's some kind of opportunity or new project in the business. It could relate to the acquisition of a competitor. It could be the opportunity to tender for a new contract. It could be an expansion of a contract with a new customer or an expansion into a new geography. But there's some kind of investment required for additional cash flows, and there's financial analysis required in order to inform a decision on whether that's a project that should be pursued or not. So I just want to touch on what I see as a few key topics and things that can be overlooked or aren't necessarily considered or understood. And that includes, if you think about when you're doing forecasts for a project, what do you actually need to forecast? Are you going to forecast out the whole business inclusive of the project? Are you going to focus on the specific project? And what you should be doing is focusing on incremental earnings or incremental cash flows. So when you make decisions about projects, you focus on incremental cash flows. And what that means is, and how you define incremental cash flows, is if you think about a company's cash flows with a project and you compare that to the company's cash flows without a project, and the difference between those two are the incremental cash flows to the project. And I'll talk about that in a little bit more detail in a moment. The other thing I want to talk to you about is which financial measures you should be looking at and considering in informing your project decisions. There's the traditional accounting measures such as net profit before tax and EBIT margins, which most of us are familiar with. But there's also discounted cash flow measures, which are potentially the measures that we should be more focused on when we're looking at projects. And lastly, I want to have a bit of a discussion around how you can incorporate some risk analysis into your project evaluation when you're doing this work. So I'll just start by looking at incremental cash flows. And as I said, we define incremental cash flows as if we look at the company, including the new project, and compare it to the company without the project. And then the variance between those two things is what we define as the incremental cash flows. Now, when we're looking at incremental cash flows, there's a few things in particular to watch out for, being opportunity costs, sunk costs, and the effects on the existing business. Opportunity costs are where we have some kind of resource or asset or capacity which we can utilize into a new project. And what we need to think about is, what are we taking that asset or utilization away from? Did it have an ability to generate income in another capacity on an existing business or another project? And if it does, we need to consider that cost in our incremental cash flows. Equally, we need to think about sunk costs. And sunk costs are costs that have been incurred to date for a potential project, which we haven't made a decision to go ahead on yet. So it could be research and development costs, planning costs. And so if you think about sunk costs and the fact that, if you look at the company with the project and the company without the project, in either scenario, those sunk costs have occurred. So they're not, when we're trying to make a decision on should we go ahead with the project, sunk costs aren't something that we take into account, and we don't consider them an incremental cash flow. And in terms of effects on the existing business, again, we need to be thinking about if we are launching, for example, a new product. We've got an existing business and we're perhaps launching a new product in the same market. Are there any impacts on the existing business that we need to take account of when we consider the project incremental cash flows? So what I've got here are 5 examples of particular types of cash flows. And I'm going to go through and describe each of them. And what I want you to do as I go through these is have a think about whether you think that they're an incremental cash flow of the project and whether you would include them when you're forecasting out to make an assessment on a project. So the first one we've got is sales associated with the new product. That one's probably relatively straightforward. If we have a new project and there's sales associated, that should definitely be included in our analysis and is definitely considered an incremental cash flow. But what about if we've got a reduction of existing sales as a result of introducing a new product? So that new product is cannibalizing some of our existing product sales. And again, we would think of that as an impact on the existing business and something that is incremental. So when we include our sales of the new product, we also need to include a negative cash flow to account for the fact that we, in introducing this product, will also cannibalize some of our existing business. The next item is expenditure on plant and equipment, which is required for the project. Again, that's obviously specific and required of the project, and therefore is an incremental cash flow to the project. This next one, a little bit trickier. So if we've got a situation where we've got excess distribution center capacity, so we've got an existing business, we've got a distribution center, it has excess capacity, and that capacity can be utilized within the project. Should we take into account the cost of that excess capacity in the incremental cash flows? To be honest, this one could go either way. Let's see what I had. It's not an incremental cash flow. What we actually need to think about is the opportunity cost. So we need to think about, with that excess distribution capacity, was there an ability to utilize it for another purpose? Could we, without the new project, could we generate income from that excess capacity? Could we rent it out to a third party? And if we can't, so if there's not an ability to do that for whatever reason, we wouldn't consider it to be an incremental cost, because in either circumstance, it's not generating income, or there's not an opportunity cost of using it into the new project. If it was something where it could be used for another project, or we could rent that space out to a third party, we would consider that it was an incremental cash flow. And then lastly, thinking about cost of research development that has been undertaken in relation to a project over the last 3 years. If we think about, comparing the cash flows of a company with the project and without the project, again, you would have this cost of research in both circumstances. So it's a sunk cost, and it's not something that should be included in your incremental cash flows, at least for the purpose of making a decision of whether you go ahead with the project. So we exclude that one as well. So hopefully that gives you a little bit of an understanding of incremental cash flows and being aware of looking out for opportunity costs, sunk costs, and the effects on the existing business. I just want to focus next on some of the measures that you should be more focused on when you've prepared your incremental cash flows and you're needing to make a decision on whether you go ahead with the project. I'll come back to these first two items shaded in yellow, which are our discounted cash flow metrics, and just talk about first some of the accounting rate of return measures which you might be more familiar with, whether it's net profit after tax, earnings before interest and tax, EBITDA, and their equivalent margins. If you look at the strict financial theory in terms of making decisions around projects, it says that you shouldn't necessarily focus on these metrics. I would say more pragmatically that you should definitely include them in your analysis. They can be informative to the extent that they are measures that you are familiar with. It gives you some context around what the project looks like. It might help you in identifying whether there might be an issue with the project cash flows, and you can compare, for example, net profit after tax for the project compared to what you're used to seeing in the existing business. So I would argue that they're still useful. They should be utilised and used in project analysis. But really what we say is more recommended is some of the discounted cash flow measures. And so if you are looking at a new project and you're in a finance team, or you're talking to your finance team, you should be asking them if it's possible to include some of these discounted cash flow measures, whether it's net present value or internal rate of return. Now, net present value measures a project's net contribution to wealth, being the present value of its cash flows minus the initial investment. Internal rate of return is perhaps slightly more intuitive. It is expressed as a percentage and represents an annual return over the life of the project based upon the amount of capital invested. So as an example, if you had a 10% internal rate of return, what that is telling you is over the life of the project, which might be 5 years, based upon the capital that has been invested, it is expected to make a 10% internal rate of return. These particular discounted cash flow measures are considered to be more appropriate in assessing projects because they discount, or they use present value methods to discount cash flows, and they also are cash flow based rather than being accounting based. And the reason that cash flow based is better is because it takes out some of the discretion that can be used from an accounting perspective. And when we're focused on cash flow, it includes CapEx when that CapEx occurs. So yeah, I guess to summarize that, very much worth using the accounting metrics which you might be more familiar with, but to the extent possible,